What's up everyone, my name's Zach and welcome to the ZVP Show. So in my first video I talked about the 5 ways to build wealth in 2020 and the 5th way was to build your credit score. If you didn't see that first video, be sure to go back and watch it. I'll drop a link down in the description. Before we can talk about how to build your credit score, we need to first understand the credit scoring system. It's a scoring system that lets lenders and financial institutions assess the risk of lending money to someone. It's a way for those lenders and financial institutions to assess the likelihood that you're going to pay back the debt that you accumulate over time. And your credit score is needed to be able to get different forms of financial lending such as auto loans, home loans, credit cards, and other forms of financing. And your score ultimately determines the interest rates which you're able to get for those lines of credit. So the higher your credit score, the lower your interest rate. And as a disclaimer, before we go ahead and get started on the credit scoring system and the factors that go into it, I will say that the system in a way is kind of messed up and doesn't always make the most sense. But it's kind of the way that it is, and we can play to its favor so that you can get a higher credit score. The exact way that your credit score is calculated is kind of a mystery, but there are 5 factors that go into it. So here are the 5 factors that make up your credit score. First is on-time payments, and that makes up 35% of your credit score. So be sure to always pay your bills on time and don't miss it. With the updates in the FICO 10 scoring system, lenders will now be able to pull the past 24 months of your payment history. So missing a payment, even just one, is really bad for your credit score. The next factor that goes into your credit score is your utilization rate, and that accounts for 30% of your credit score. This looks at how much credit you have available to you versus how much you actually use. And the higher your utilization rate, the more negative impact it has on your credit score. So if you're constantly maxing out your credit lines, this lowers your score because it makes you look like a more risky borrower. Third is the age of your credit, and this accounts for 15% of your credit score. Lenders want to see that you have a longer history with credit that's in good standing because that means you're a responsible borrower. That's obviously a good thing and will increase your credit score. Fourth is different types of credits, and that makes up 10% of your credit score. Lenders like to see different types of credit mixes, not just a person that has one credit card that gets paid off each month. They want to see you borrow different forms of credit, such as an auto loan, different types of credit cards, and maybe even a home mortgage. This shows that you're a responsible borrower that can handle multiple types of credit. And the 5th factor that goes into your credit score is credit inquiries, and that makes up the last 10% of your credit score. Specifically, these are hard inquiries. So when you go and apply for new lines of credit, such as credit card, an auto loan, or maybe even pre-approval for a home mortgage, this goes on your record as a hard inquiry. Lenders see this as you trying to go out and open up more lines of credit, which then makes you look like a riskier borrower. So we can use the understanding of the scoring system to our advantage and boost our credit score. So first things first, always make payments on time. This has the highest impact on your credit score, so always be diligent in paying on time. If for some reason you have a missed payment on your credit history, but you know that you've always paid on time, you can usually have this looked into and overturned by a credit agency as long as you have documentation. And second, always pay off your credit cards in full. Credit cards should never be seen as a way to borrow money or as an emergency fund. You should use them for your normal spending and then pay them off in full at the end of each month. Be sure to never carry a balance over from month to month because that's when you incur interest. And the average interest rate for a credit card is over 19%. And third, you should not be afraid to increase your credit limit. This might sound counterintuitive, but lenders want to see you have a small account balance. So it helps to have more credit available to you that you're not using. This helps with your utilization rate, which has the second highest impact on your credit score. So for example, if you have $2,000 in credit available to you and you use all $2,000, that shows that you have a 100% utilization rate. But if you have $40,000 available to you and you spend that same $2,000, you're only using 5%, and that looks very good. Usually, you want to keep your utilization under 10%. Once you start to exceed 30% utilization, it can have negative implications on your credit score. And fourth, try to keep credit lines open as long as possible, mainly meaning credit cards. When you close an account, this drops the age of your credit, which ultimately drops your score. But if you have a credit card that charges an annual fee and you no longer use it, it makes more sense to cancel that card. This only impacts 15% of your credit score, so it's worth it to not pay the annual fee. And last but not least, the 5th way to build your credit score is to keep hard credit inquiries to a minimum. Usually anything more than 2 hard pulls in 1 year will impact your credit score negatively. If not avoidable, don't worry about it too much since this has a smaller impact on your credit score. And your score may only drop 5 to 10 points depending on how many inquiries you had in the past year. Thank you all for watching this video, and I hope you take these principles and apply them to help boost your credit score. Be sure to hit that like button and subscribe to the channel.